Imagine if you planted a seed today and it grew a little each day, not just from the original seed but from everything it grew the day before. In 10 years, you wouldn't just have a tree, you'd have a towering giant. This is the power of compounding, and it can do for your money what nature does for that tree. Compounding interest, often hailed as the eighth wonder of the world, is the process where your earnings generate even more earnings over time. By reinvesting the returns you receive, you're setting off a chain reaction of wealth creation that builds momentum with each passing year. In this video, we're diving into 10 potent assets that utilize this remarkable effect to expand your investments significantly. They all harness the relentless power of compounding to boost your financial growth. So, if you're ready to see how your investments could evolve, stay tuned as we explore each of these assets in detail. Let's start by defining what compounding interest really is. Imagine you invest $1,000 at an interest rate of 10% per year. In the first year, you earn $100 in interest, making your total $1,100. Now, here's where compounding comes into play. In the second year, you earn interest not just on your original $1,000 but also on the $100 interest from the first year. So, your second year's interest is $110, bringing your total to $1,210. This process repeats year after year, and your investment grows exponentially because you earn interest on your interest. This might sound simple, but the implications are profound. Compounding can transform even modest investments into significant sums over time, turning financial patience into a lucrative virtue. The longer you leave your money to grow, the more dramatic the increase, as the compounding intervals stack upon each other. Let's look at this graph showing $1,000 invested over 30 years at a 10% annual return. Notice how the growth curve becomes steeper as time progresses. Initially, the changes might seem small, but as compounding continues, the value skyrockets. By year 30, the initial investment grows to over $17,000 without adding any more money to the account. This is the power of letting your money work for you over time. As you can see, the true magic of compounding lies not just in making money, but making money on the money you've already made. It's about playing the long game, setting the stage for financial security that can extend well beyond your initial expectations. Number 1. Growth stocks. Growth stocks represent companies with potential for significant revenue and earnings growth well above the average market. Unlike dividend stocks, which pay regular returns to shareholders, growth stocks typically reinvest their earnings back into the company to fuel expansion, product development, and innovation. This reinvestment acts as a catalyst for compounding growth, as the value of the investment increases not only from rising stock prices, but also from the company's expanding ability to generate more profits. Over time, as the company grows, the returns on the initial investment can multiply at an increasing rate, exemplifying the compounding effect. Thus, investors in growth stocks benefit from the company's enhanced market position and potential for substantial long-term gains. Number 2. Dividend-yielding stocks. Dividend-yielding stocks offer a unique dual benefit for investors. First, they provide a steady stream of income through dividends, which are portions of a company's profit paid out to shareholders. This regular income can be especially appealing for those seeking consistent returns. The second, and equally significant, advantage is the potential for reinvestment of these dividends. By automatically reinvesting the dividends into purchasing more shares of the stock, investors harness the power of compounding. Each reinvested dividend increases the number of shares they hold, which in turn will generate even more dividends, effectively growing their investment exponentially. This cycle enhances the value of the initial investment over time, leveraging compounding to build wealth steadily. Number 3. REITs, real estate investment trusts. REITs are investment vehicles that own, operate, or finance income-generating real estate properties. Structured to distribute at least 90% of their taxable income to shareholders in the form of dividends, REITs are a popular choice for income-focused investors. This structure ensures a consistent flow of dividend payments, making them highly attractive for those seeking regular income from their investments. The compounding potential in REITs comes into play when these dividends are reinvested back into purchasing additional REIT shares. Over time, this reinvestment strategy increases the total number of shares an investor holds, which means receiving dividends on a growing number of shares with each distribution cycle. As the investor's share count increases, so does their potential dividend income, allowing the investment to compound and grow in value through both asset appreciation and dividend reinvestment. This makes REITs a powerful tool for compounding wealth within the real estate sector. Number 4. Index funds. Index funds are designed to mirror the performance of a specific benchmark, such as the S&P 500, providing investors with broad market exposure and diversification across numerous sectors and companies. This strategy offers a key advantage. It mitigates individual stock risk while capturing the overall market's growth trajectory. The real compounding power of index funds, however, emerges from the reinvestment of dividends. When dividends are automatically reinvested, they purchase additional shares of the fund, which then generate their own dividends, further expanding the investor's holdings over time. This cycle of reinvestment continually boosts the number of shares owned, enhancing the fund's growth potential. Over long periods, this strategy leverages market performance and dividend reinvestment to compound wealth, making index funds a cornerstone for building long-term financial security. Number 5. Managed mutual funds. Managed mutual funds are overseen by professional fund managers who actively select securities with the aim of outperforming the market. This active management plays a crucial role in capitalizing on compounding through strategic investment decisions. Fund managers can adjust the fund's portfolio in response to market conditions, targeting securities that offer higher returns or that are poised for growth. Furthermore, these managers can decide to reinvest dividends and capital gains back into the fund, purchasing more shares on behalf of the fund's shareholders. This reinvestment enhances the potential for compounding, as it increases the value of the fund's assets over time. The expertise of fund managers in making these timely reinvestment decisions is key to maximizing the compounding effect and thereby boosting the overall return for investors in managed mutual funds. Number 6. Exchange-traded funds, ETFs. Exchange-traded funds, ETFs, offer a versatile investment option, available in a myriad of varieties that span across different sectors, asset classes, and investment strategies. From broad market ETFs that track major indices like the S&P 500 to specialized ETFs focusing on sectors such as technology, healthcare, or even commodities, investors have the flexibility to tailor their investment portfolios according to their specific risk tolerance and market outlook. This diversity allows investors to potentially benefit from growth in traditional individual retirement accounts. Compounding in ETFs occurs significant reinvestment of dividends compounding. Similar contributions to traditional IRAs, many ETFs automatically reinvest income and other shareholders, allowing them to invest more additional shares with the dividend. The real power of traditional IRAs not only helps in the smoothing out volatility by increasing market exposure during dips or interest, but also amplifies this means that all investment returns can be reinvested without being diminished by taxes. Over time, allowing this reinvestment strategy compounds, this tax deferral significantly enhancing the investment's value by leveraging growth when the investor may be in a lower tax bracket. Thus, ETFs serve as an effective tool for investors looking to capitalize on the benefits of compounding diversified, significantly enhancing and often cost-effective. This mechanism makes traditional IRAs a cornerstone for long-term retirement planning, capitalizing on years, if not decades, of tax-deferred growth. Number 8. Roth IRAs. Roth IRAs stand out in the retirement planning landscape due to their unique tax treatment, which allows for tax-free growth and withdrawal. Unlike traditional IRAs, where contributions are tax-deductible but withdrawals are taxed, Roth IRA contributions are made with after-tax dollars. This means that while contributions do not reduce your taxable income today, the growth and withdrawals are completely tax-free, assuming certain conditions are met. This tax exemption applies to any earnings from investments, whether from interest, dividends, or capital gains. Since the investments in a Roth IRA grow tax-free, all reinvestments are made without the immediate tax liabilities, allowing the full amount of the earnings to compound over time. The absence of tax obligations upon withdrawal further enhances this benefit, making Roth IRAs exceptionally powerful for maximizing long-term wealth through compounding. This structure is especially advantageous for younger investors or those who believe they will be in a higher tax bracket at retirement. Number 9. 401k plans. 401k plans are a popular type of employer-sponsored retirement savings plan that significantly enhance wealth accumulation through consistent contributions and employer matching. Employees can elect to have a portion of their salary automatically contributed to their 401k plan, often before taxes, which lowers their taxable income and allows more money to be invested upfront. The real boost in compounding comes from employer matching programs, where employers contribute additional funds to match the employee's contributions, often up to a certain percentage of their salary. This essentially provides free money that also benefits from compounding. Over time, both the employee's contributions and the employer match continue to compound, growing the total balance more rapidly. The regular, automated contributions ensure that employees take advantage of dollar-cost averaging and do not miss the opportunity for their investments to grow through the market's ups and downs. This structured approach to saving and compounding can lead to substantial growth of retirement funds, providing a robust financial foundation for the future. Number 10. Commercial and residential real estate. Investing in commercial and residential real estate offers unique compounding benefits through the strategic reinvestment of rental incomes and the appreciation of property value. For property investors, rental income provides a steady cash flow that can be reinvested into further property improvements, additional real estate purchases, or other income-generating assets. This reinvestment strategy enhances the property's value and can increase rental yields, compounding the investor's returns over time. Additionally, as real estate values generally appreciate over the long term, the increased property value compounds the overall investment return. By strategically reinvesting gains from property appreciation, investors can leverage their initial capital into larger or more numerous properties, further amplifying the compounding effect and building significant wealth through real estate. If you want to learn more about achieving financial success, watch this video next. If you made it to this point, please like and subscribe to this channel to see more content like this. Thanks for watching, and I'll see you in the next video.